Good morning. Trump's housing crackdown creates a clear winner, and that's Build to Rent or BTR. So, President Donald Trump's latest housing policy is reshaping the investment landscape for U.S. residential real estate, while the initiative directly targets institutional investors purchasing existing single family homes. It includes a critical exemption, one that materially benefits Build to Rent or BTR developers and capital providers. And that distinction is deliberate. BTR communities add new housing supply rather than competing with individual homebuyers. And in a market defined by affordability pressure, limited inventory, and elevated mortgage rates, that difference matters. And policymakers are signaling it pretty clearly. So, why build to rent is exempt? Well, the executive order draws a bright line in between demand side investors who buy existing single family homes, but also supply side developers who are constructing purpose built rental communities. And BTR developments expand housing stock, support local job creation, and relieve pressure on entry level homebuyers. And by exempting them, the policy effectively positions BTR as part of the solution, not part of the problem. Now, what this does is it provides the housing sector with regulation clarity, lower political risk, but also greater confidence for long term capital deployment. So, institutional capital is already moving in this sector, and large housing investors have been repositioning well ahead of the announcement. And firms such as Invitation Homes, Pretium, and Quinn Residences have been steadily reallocating capital away from scattered site acquisitions and toward master planned rental communities. So you may be asking yourself, why the shift? Well, the big answer is operating efficiency and scale. And we can deliver consistent construction quality with this method. But there's also predictable lease up and expense profiles across a community. And it's reduced exposure to future regulatory action. And major home builders such as D.R. Horton and Lennar have reinforced the trend through partnerships that align development expertise with institutional balance sheets. So let's look at some suburban markets that stand to benefit the most. And the implication for high growth suburban markets, including Texas metros like Katy, Fulshire, and West Houston, are significant. And as affordability challenges persist, BTR communities are increasingly filling demand in where there's strong school districts, when there's job rich suburban corridors, but also areas where homeownership can remain out of reach. And since 2012, more than 321,000 build to rent homes have been delivered nationwide, with the majority constructed in just the past 5 years. And higher interest rates, elevated home prices, and changing household preferences have accelerated adoption well before federal policy caught up. So here's some remaining risks to watch. So despite the tailwinds, some uncertainty remains. So it's important to do pre-construction portfolio sales to investors, and do they qualify under that exemption? Could future legislation narrow the carve out here? And how will local zoning and infrastructure constraints respond to such rapid BTR growth? And the point is until clearer guidance emerges, some investors may remain cautious, but the policy direction is now unmistakable. And here's the bottom line. Build to rent was already a structural growth story, and President Trump's housing crackdown legitimizes and protects the model, which is going to accelerate its role in the U.S. housing supply and signaling how a long-term shift in suburban housing can be financed, developed, and occupied. So for developers, for lenders, and investors focused on scalable residential strategies, BTR just received its strongest endorsement yet. And that, my friends, is it for the day. Please visit my website, houstonrealestatebrokerage.com. Love to get a hold of you and talk a little more about the situation. Have a good day.